Fantastic evening it is to you viewers. Welcome to Equity News on EquityAxis, your cross-section of stock markets and of developments in the Zimbabwean economy. Thank you for joining us as a broadcast from Hampton Studios. I'm Ibn Mabonda. Let's go. The Minister of Information and Publicity, Honorable Monica Mchangwa, highlighted that Zimbabwe's power issues are, among other issues, to do with electricity import cuts. This, she said, during a post-cabinet media briefing. Let's have a look.
Implementation of the following projects: Bay Bridge Border Modernization Project. The project involves, among other things, the upgrading of the border post through the construction of new terminal buildings, commercial facilities, construction of a fire station, upgrading of water and sewer reticulation systems, and construction of staff housing for border agencies. The Zim Borders, the contractor of the project, has already started construction of the maintenance building and civil works. He also gave an update on Ponda Tekobanin heavy haul rail and deep sea port project. This project involves the development of new interregional heavy haul railway system linking the core fields of Zimbabwe and Botswana with contractual access to a modern deep water seaport in Mozambique. The project was mooted upon realization that the existing railway line may not adequately accommodate the transportation of Zimbabwe and Botswana's coal exports and fuel imports to and from the seaports in Mozambique. The project is to be sponsored by the governments of the two countries, while private sector participation will be encouraged. A feasibility study on the project is scheduled to start before the end of this year. The Minister of Transport also gave an update on the Kazungula Bridge and the one-stop border post project. It should be recalled that Zimbabwe became part of the Kazungula Bridge and one-stop border post project at the Kasane Summit in 2018. With respect to Zimbabwe, the project entails construction of a new tri-national one-stop border post with an entry terminal and a road diversion access in order to facilitate entry and exit for traffic from Botswana and Zambia. Cabinet approved that a consultant be urgently sought to carry out the feasibility study, look at the designs and the associated modifications.
The Minister of Energy and Power Development, Advocate Fortune Chassis, also shed light on the vast amounts owed to ZESA. Now, just to look into the stats, earlier on we reported that part of the power crisis that Zimbabwe is currently grappling with was to do with a decline in electricity imports. In 2017, Zimbabwe imported on average $16.2 million per month of electricity. 2018, an average of 17.6, but since October, Zimbabwe has reduced its electricity imports by about 83%, from $17.6 million to just $3 million. So among other issues, this is what has resulted in Zimbabwe's power crisis. Meanwhile, Minister Monica Mchangwa also gave an update on infrastructure developments in Bay Bridge as well as the Kazungula border post. Once again, let's listen in.
Status report by the Minister of Energy and Power Development on the country's fuel and energy supply situation. The report showed that the fuel supply situation remained fairly stable. Concern was, however, expressed over the long duration of electricity power supply load shedding schedules, which was hitting both domestic and business consumers. Government has stepped up efforts to service its power imports debt arrears so as to ensure continued power supplies. So money will be paid to make sure that we improve the power supplies. As part of demand-side management measures, government ministries and government agencies should install meters to help them to closely monitor their power usage. all local authorities and other consumers are called upon to settle their bills with ZESA so as to improve the power utilities viability. Government is also engaging stakeholders in the liquefied gas subsector with a view to ensuring smooth supply of the product at affordable prices. I want to thank you.
The Zimbabwe Stock Exchange today announced a new set of listing requirements. Among the new rules, the ZSE introduced a new financial reporting monitoring panel which will be set up to assess the authenticity of financials released by listed companies. Furthermore, listed companies will now be required to issue quarterly reports with an exclusive interview with the Chief Executive, Justin Ngoni. Let's listen.
So, as I said, the most important thing is to bring transparency to the market. So what you want is, call it information asymmetry. So what you want is you want the shareholders to have as much information as possible, as much as what the directors know. So by reporting more often, it means shareholders are getting more information and they can make better decisions. That's what the market is. The market needs information for people to make decisions. Yeah.
Okay. Yeah. But what would be the depth as well as the timeliness of the quarterly reports?
Okay, so in terms of the quarterly ones, the depth is not as much as obviously the half-year or the annual ones, but that information helps because you will know how the company is. So we will issue a notice explaining exactly what information we need, but it won't be as detailed as what you get in the half-year and the annual one. Does that make sense?
I realize. Okay. Then maybe to talk about some development in the course of the year. Zimbabwean domiciled companies were removed from the S&P African indices.
Yes.
Right. What is your comment with that is concerned as well as the potential of those companies actually being reinstated onto?
So the main reason why that was done was mainly because of, in terms of repatriation of dividends and capital. So what it meant is when there was less, it wasn't liquid. So what we're happy about now is, which we've been waiting for, is the interbank market seems to be working more and more. And we've agreed with the Reserve Bank that at least 15% of the interbank should be used to repatriate dividends and capital. So what we're hoping is this works, then we'll be able to go back. So that was the main reason. The main reason was the liquidity. Okay, people would take their capital out.
So where could those companies perhaps be reinstated?
So let's see how the interbank works. Then we can go back to S&P and say, please consider this.
Okay, I realize. Thank you very much.
Old Mutual Group fires Peter Moyo following suspension on conflict of interest grounds. Peter Moyo was the chief executive of the JSE listed group. Meanwhile, JSE biggest company Naspers is set to relocate from the JSE for Europe. This concludes our evening news bulletin. Up next is a look at the news in our news review. Please stay tuned. Welcome back, viewers. It's time for news review, and with me here is Tinashe Kaduo, an economist. Tinashe, good evening and welcome to the show.
Good evening, Eben. How are you today?
Can't want to complain. Should only get better yourself.
I'm quite well.
Splendid. Now, let's talk about the key issues that are actually playing out. Government there explaining how we are currently grappling with power issues, and one of the key issues there being electricity imports. What is your comment with that is concerned, given what we have actually indicated earlier?
If you look at what we discussed, sometime earlier on, we actually, attributed, to these electric shortages to a drop or a sudden drop in terms of our monthly imports. If you look at over the past couple of months from 2017, and I think around 9 months into 2018, before the onset of this serious, austerity measures, we actually used to spend on average on a monthly basis 17.6 million on electricity. So if you look at, I think this graph kind of explains it quite well. If you look at this sudden drop from 17.6 million to 3 million, that's a gap of about 40 million per month. So if it means that we continued to get the same amount of electricity from our key suppliers out there, it means that on a monthly basis we had a deficit in terms of payment of about 14 million on a monthly basis, which we are accruing as debt. So if you see, when we started experiencing serious electricity shortages, it was around May, and this cut in terms of spending on electricity imports, it happened in October 2018. So from October 2018 to May 2019, that's about closer to 9 months. So if you multiply 9 months by a gap of 14.6 million, it means that we have accrued closer to 140 million, which we are actually accumulated as debt. So it's actually a serious concern there, and there is no way those countries would continue supplying us electricity when we have such huge debt overhang. But I think what's needed now is for even the Auditor General and all those and the accountant, the government accountant, to really look into ZESA books and see the exact quantum of debt that we owe as a nation. You might be surprised here to find that our debt is surpassing a figure of 200 million of electricity alone. I think Zimbabwe, what we need is actually a serious debt stock, such that we know where we stand as a nation. This is actually a serious issue, which is actually a concern even to investors out there. It's actually adding a cost to our cost of doing business, and it's actually something that will continue hampering our FDI inflows. I know even during the day you discussed in your special focus, you touched something on foreign direct investment, and you actually pointed out something that actually moved me, where you said in terms of ease of doing business ranking, we are ranked what did you say?
155 out of 190.
Yes, and these issues to do with debt, huge debt overhang, corruption, poor infrastructure, including this quality of electricity, it will actually adds on to that.
Yeah, because look, among other issues, among other countries, you'd find South Africa ranks 82, Zambia and Botswana rank 87 and 86, while the best country now on the continent will be Mauritius at position 20. So all these issues come into play when we look at how Zimbabwe actually performs against the international community.
Yeah, and if you look at for instance Zambia and South Africa, those countries, over the past couple of years, they've been investing much in their infrastructure, including electricity, which we are now grappling from. So if you look at them, your investment, you'd want, to invest in a country where you can, easily access, good quality electricity, where the roads are good and where the rail is functional. So those are some of the issues that are actually, affecting our country. And if we don't invest in those, key infrastructure items, I don't think we'll be able, to attract much needed foreign direct investment.
Now, let's talk about the ZSE, a new set of rules that have just come in, several changes that can be expected as a result. But in my exclusive interview with the Chief Executive, Justin, he made mention of the fact that there is need for more transparency in the market. He also added the fact that we will have companies that are listed giving quarterly reports. They may not be as comprehensive as the half year as well as the full year, but during the first, second, third and fourth quarter, there must be the publication, there must be a release of or how the company would have actually performed. What is your comment where that development is concerned?
You know, the stock market actually is a market that requires a lot of transparency and, you know, easy accessibility to information. If you look at, you know, most of the markets in Africa, with the exception, you know, of your Mauritius, of your South Africa, of your Egypt, if you look at most of these markets, they are a bit of opaque in terms of availability of information. Information is not readily available. It's those internal people that, you know, is, you know, much privy to that information. So I think this is actually a good move by the Zimbabwe Stock Exchange for more transparency, and even, you know, to showcase, you know, to the world that, you know, we are now being open to what will be happening in terms of the dealings on the Zimbabwe Stock Exchange. I think it will also help to build, you know, more confidence among, you know, those foreign investors who will be eyeing, you know, some of the listed companies on the stock market.
Well, then, of course, NRZ is set to spend $15 billion on its fleet. How important is that to the country?
That's actually, you know, a very positive development as well. We are talking, you know, when we are touching that aspect on electricity, we actually did mention that, you know, investment in those key infrastructures is much needed. If you look at how the economy was set up traditionally, it was, you know, your Wange, your NRZ, and your Zisco Steel, which were actually those key industries. They were actually, you know, the main drivers of the economy. Your Wange was producing, you know, your core, then NRZ carried the load to feed into Zisco Steel, and Zisco Steel will produce that steel that will also be ferried, you know, by your NRZ to key industries, including your Willowville motor industries. So, you know, the death in terms of your NRZ, in terms of its efficient operations, also coupled, you know, with the death in production at Zisco Steel as well as at Wange, actually, you know, added to the rapid deindustrialization. If you look at even the players in the chrome industry, they are saying that they are not able, you know, to export as much tonnage of chrome as they would want because of, you know, high cost of transporting, you know, chrome from, you know, the mining town of Kwekwe to the nearest port, which is Beira. So on average, they were saying that they are being charged, you know, 175, you know, US dollars per ton to ferry chrome from Kwekwe to Beira. So if you look at chrome, it's a commodity, you know, that costs around, you know, 150 US dollars per ton in the international market. So it's a volumes game. The more tonnage you move, that's the more, you know, profitable that you will be as a player. So if we are seeing that these are companies, you know, these are players that would want, you know, to move tonnage like, you know, 500 tons and so forth. So you can't do it over road using road. You need rail. So I think the move, you know, by NRZ, I think it will help, you know, resuscitate or make, you know, operational improvements or operational efficiencies of some of those industries that rely much on NRZ. This includes your chrome mining industry and even your coal mining industry as well.
Well, thank you, Tinashe, for the perspectives. But of note is the fact that you made mention of several minerals. Tomorrow there's an MMCZ event that will, of course, be covering. So we'll actually have a bit of a report on how things would have played out. Thank you, guys, for staying with us. Up next is a look at the stock market. Don't go anywhere.
Welcome to Markets Daily on EquityAxis. My name is Anis Chumbomu, and joining me today is our Chief Analyst, Respect Gwenzi. How are you doing today, Respect?
I'm doing just good. And you, Alison?
Pretty well. Pretty good, actually. Well, today was a pretty slow day on the market as compared to the prior sessions that we've experienced. with averages of around about 3-4%. Now today it did come up again, stretching that rally by about 0.29% for both the all-share index and the industrial index. Those two indices settled at 219.03 points, 731.22 points for the industrial index. Mining's index was stable. Top 10 index only inched up 0.35%. I think the drag came in from an Econet drop there by about 1.88%, as well as Padinga that lost out 1.1%, and Sitco letting go for about 0.55%. Do you think that there could be continued profit taking for the next couple of sessions right now, or it's just an impasse there?
When you notice the kind of gains that were realized in the first session of the week, they were quite huge.
Mm-hmm.
If you're looking, for example, Econet alone, it gained about 29%, and it also follows that, Padinga had also a huge margin of more than 20%.
Mm-hmm.
I think that shows you the magnitude of prior sessions gains, and it would only be fair for a counter that has risen such, by such magnitude to result in profit taking. So I think what we are now seeing is a bit of profit taking in select counters that have realized huge gains in a very small or a very short period of trading. But lately trades have been choppy. If you look at the trend over the past 3 weeks in terms of particular counters, especially the top 10, we have realized quite notable volatility in trades of especially heavy cap counters. So it's only fair for investors to take profits, but the general momentum is likely to be sustained. We're likely to see further growth in terms of stock market gains.
All right, industrials index is now up 13.03, 13.02 for the all-share index. Top 10 index showing the stronger movement there, up 15.94, while the mining's index is just up 7%. No particular movement for that mining index today.
Yes, so the mining index lately has just been connected to Bindura. Its movements have been limited to the direction in which Bindura takes. This is mainly because there are now only two counters which are trading actively on the stock market among the mining counters, and that's BNC and Rio Zim, given that Wange is now under reconstruction and then Forward has been suspended. So Bindura has been generating quite some momentum over the past few sessions. Last traded at 13, which was a gain of about 18% on its prior close of about 11 cents. So I think, of course, once we start to see Bindura's momentum retaining to the market, then the mining index might also move.
Okay. Out of 4 rises, CBZ led up again 7.41% for it to settle 45.37 cents, while Econet Padinga and Sitco did close at their set of laggards, coming off 1.88%, 1.1, and 0.55%. Pretty much top 10 index stocks.
Yes. So most of these top 10 counters are dominating the downside of the market, and by virtue of weight, that's why they had to moderate the kind of gain that we realized today at about 0.2, 0.3 thereabout. Okay. But I think generally it still remains a buyer's market. If you see the kind of bids that are there in the market, they are very much in the positive, and that trend I think it's likely to remain with us. But if you also look at when you look at market breadth in terms of rises and fallers, the difference, it still shows that there is a good momentum, especially on the gainer side, in which today we're led by the FMP. We're still having counters which are reaching the bar in terms of hitting the maximum that's allowed in terms of daily movements, and that shows momentum in my own view.
Okay. For that market breadth today, we did experience a market breadth of 10 with 14 rises versus four laggards there. FMP, like you did mention, hit the ceiling there, 20%.
But I don't know about the volumes and values today. Were they as far?
No, they actually came off again today. So yes, the demand on the market seems to be very much slowing down, pretty much because of how we speculated that most investors may be holding on to most of the stocks that they have, just waiting on a better movement in terms of or a greater profit margin that they could skim off.
Yeah. So in my own view as well, I think the challenge here is about where do you put your money next. If you choose to decide to forgo your stocks, are you gonna get into hard balances? I mean, in terms of RTGS, or are you going to get into property? It's not, most of these investments are quite marginal. These are people putting in their 3,000, 5,000, 10,000 in RTGS terms, and that money is not worth, or it's not enough to buy some real property. So the only alternative could be money market or even to get into hard currency. But it's also a function of what level you'd have got into the market. So for most institutional investors, they bought these shares, I mean, some years back in real US dollars, so they're actually in lost positions. And it would only help to just keep preserving value or maybe retaining the minimum value by holding on to those assets. So I think people are holding on to their shares. There's no room for selling in a market where you know that the alternative is losing money via RTGS balances in the bank. So in my own view, the demand is still there. People are holding on. It's because everyone is demanding stock, and because that's the only alternative that we have.
And I suppose it wouldn't be so much of a gain even for the smaller traders with regards to how they would probably take their profits in perspective of how they're going to put where they're going to put their money next. Because I'd suggest some of these small traders are probably then going onto the parallel market just to try and preserve their value via the US. But the US dollar seems to continue losing value on a daily basis, even on the parallel market. Parallel market settled at 9.4 today, up from 9.25 yesterday. The interbank rate is at 6.12, up from 6 yesterday. But then the old mutual implied rate did strengthen a little bit today at 10.4 because of the JSE drop today, mainly because of the Peter Moyo resignation day. What do you think would be the best option for smaller traders, considering how the parallel market and the old and the interbank has been performing?
There's an opportunity to gain from the stock market presently. For those who are holding stock, it depends at the level at which you bought your shares at. Let me give you a clear example. If somebody bought a counter such as BNC in 2014, the share price was at about 5 cents. It's presently trading at 15, so it has gained
almost
2 times. Yes. But if you look at, so what it means in real terms is that if you committed $100, it's now $300. But that same $100 in USD, that was real USD. If you are to secure the same USD, you now need 900 in terms of RTGS. So you are basically foregoing. You are basically you have 300. And yet you want to buy 900 to retain the same value that you had 4 years ago. So that means that person is in a loss position even today when the counter is trading at about 15 or 13 thereabout. So to those people who bought in those years, I mean, it would take price gains of more than 5 times. But presently we are sitting at possibly about 3 times for some of these counters. But for those who bought shares like say a few months ago, you try to capitalize on those short-term runs. If you look at the gain on the parallel market from basically 8 to 9.4, if you look at the change, sometimes it comes at a slower rate, or it comes it comes at a slower rate than the gain that would have been realized in a certain counter like Econet, which moved 20% just yesterday, and yet the parallel market maybe it's moving at a rate of maybe about 5% per single session or per single day. So you can beat the market if you have realized quicker gains on the stock market than the weaknesses in the USD on the parallel exchange. So once you realize those gains, you can spin your money, get a bit of dollars, and then you redo the maths again.
Okay. Well, thank you for viewing us on Markets Daily. My name is Anis Shimpumo. Joining me today was Respect Quincy Don't forget to like, follow, subscribe to our YouTube, Twitter, and Facebook accounts at EquityAxis. Good evening.